Well, it's time to brace for impact because big things are happening this week. And no, I'm not talking about the earthquake that shook me out of my seat yesterday. It was a 5.1. I got an alert on my Android almost before the earthquake even hit, and then all of a sudden it's like, boom! Whoa, what was that? Oh, it's an earthquake. Oh, okay. Oh, that's kind of cool, actually. Anyway, it was quite shocking. Much more shocking than Hurricane or Tropical Storm Hillary has been for us. But then again, Baja California got the most of it. So our heart goes out to the rebuilding they're going to have to do over there with that crazy flooding they're getting. But we actually have to brace for impact here is, of course, what happens this Friday, which if you've been here long enough, you already know what happens on Fridays. Yes, Fridays at 7:05 Pacific time or 10:05 Eastern time. That's when Jerome Powell will be speaking at the Jackson Hole Symposium. There are a lot of other things that happen there, but nobody really cares. Everybody's going to care about Jerome Powell. And Nick T, the little bird who provides the leaks of what the Federal Reserve is thinking about before the Federal Reserve actually says it to sort of massage markets, has given us a little bit of a heads up of potentially what to expect. Now, before we look at exactly that, it is worth noting that the 10-year Treasury right now is up like 9.1 basis points. It's absolutely nuts that the 10-year Treasury right now is sitting at 4.34%. But then again, if you watched my video from 2 days ago, this is not a terrible surprise and might explain why markets are slightly green at the same time as the 10-year Treasury is at this level, because again, people are moving money into money markets. Why bother being exposed to the risk of treasuries when you could get the same yield on a money market, which is basically where your money goes to sit in the reverse repo facility. And if that's offering higher yields than treasuries, why bother investing in treasury? So maybe Bill Ackman, at least in the short term, was onto something here. Now, remember, I'm a big fan of looking at my portfolio from two lenses. Number one, what is my long-term game plan? And how do changes in monetary policy affect my long-term game plan? Like growth stocks and energy, are they still going to be a play if we're truly in higher for longer? And are we going to be in higher for longer? It's the worst thing to hear if you're a bull, is higher for longer. However, in the short term, we know there are hedges we can play. After all, after Tesla earnings, we knew it was bad news. Just type into Google, meet Kevin, Tesla, bull, bad news in short term. And sure enough, the stock trades down like 25%. I mean, that's okay. There's short-term trading and we can take advantage of that. Just make sure you pay attention to volatility. A lot of people get the direction right, but screw up volatility. And if you don't know anything about historic volatility, courses, link down below, but you already know that. Okay, so let's talk about what Nick T just talked about. So why the era of historically low interest rates could be over. This is not good, okay? I don't like hearing that. I personally like thinking that, hey, you know, when I look at the 5-year break evens, inflation is looking pretty stable to me. I'd like these break evens to go down a little more. Here's the 5-year break even. As you can see, it's kind of trended down over here on the right. I'll hide myself for a moment. It's trended down on the right. Okay, it's not running away. This is the 5-year forward, which is if the last one is how much inflation is expected to be over the next 5 years, 2.25, big deal. Then this is how much inflation is expected to be 5 years out and then 5 years forward. And that's at like 2.34, big deal. Okay, this is the expectation of the Federal Reserve cutting rates starting in March and getting a whole basis point down by December of 2024. And then this yet still, though, is the Fed's terminal rate. We are approaching this higher terminal rate and starting to price in a little bit of maybe that one more rate hike at about 10 to 13% chance for November. Okay, great. Again, we don't want to hear that. I mean, we got so many cuts priced in. The last thing we need is yet another hike. And remember, what matters now isn't hike or not. It's how long, bro? And this is what we're really hoping for from Jerome Powell. Well, unfortunately, this is not a good bull piece. This is terrible, actually. This here talks about how, what if the neutral rate of interest is higher? See, they write here, economists and policymakers infer this, it's this magic number, the R naught, the R star, neutral rate, whatever. It's all the same crap. Reminds me a lot of COVID and like the spread of COVID, whatever. It's all fugazi. Anyway. Basically, the idea is if borrowing and spending are strong and inflation pressures are going up, then you need to raise interest rates because the neutral level is higher than where we currently are. So again, inflation up, spending up, borrowing up, raise rates. Inflation down, borrowing and spending down, lower rates. Okay, but what about both? Is it possible that you could actually have a stronger economy and lower inflationary pressures? That's my argument, is that yes, we can have a stronger economy and lower inflationary pressures. Now, let's see what Nick T here ends up suggesting. So Nick T goes on to say that, hey, there are potentially reasons to see higher for longer, and that really maybe if we're still running at over a 2% GDP pace, which we kind of are right now, the Atlanta Fed real now GDP puts us at like 6% annualized, which is insane growth, then as Barkin here says, then we have to be higher potentially than what we thought. Now, of course, there's a risk of a monetary policy lag affecting us, right? And that's a problem. So why could this be happening? Well, maybe it's happening because of what I wrote is stimmies. They say here an increased demand for savings and investments into clean energy. I personally wrote stimmy, which is, hey, CHIPS Act and Inflation Reduction Act are basically massive stimulus checks still flowing into the market. And we still haven't seen that from the point of view of earnings at like energy companies, for example, or chip companies. But we'll see. We've got NVIDIA coming up, but really these are expected to play out over the next couple years, not over the next couple months, these stimmy checks. Anyway, what we have here is this idea that, look, it is possible though, that you could end up having a more robust economy with productivity boosting investments like artificial intelligence that end up pushing up the neutral rate, in contrast to a slow population growth and an aging population that brings down productivity. So in other words, there is this reason to suggest, hey, like, even though we think the population's aging and people are going to spend less, what if AI and retirees spending their savings actually pushes up the neutral rate? That's entirely possible. Now, Nick T doesn't really give us a conclusion here other than saying that Powell has warned against setting policy based on estimates of the neutral, which he compares to navigating celestial stars. So basically, it's impossible to figure it out. But what does this mean for us? Well, what this means is this Friday is going to be all about what is Jerome Powell saying about how long do we have to be higher. We know that he believes if inflation expectations come down and the level of restrictiveness we need comes down, we can lower rates. But when is that going to be? So what are we looking for this Friday? Hints. Does he care about the neutral rate? If he cares about the neutral rate, it's bad news. How high for how long? I don't think we're going to get a decision on November or September. I think he'll punt that. But I think he will lay a roadmap like he did last year, which last year's Jackson Hole tanked the market because he laid the roadmap that there was a lot more work to do. Well, now it's been a year. It's been an entire year. So Powell, please give us a clear path of, hey, just give us something like, as long as inflation comes in under 3%, we want to see flexible average inflation targeting. We're comfortable lowering rates because we don't want to see joblessness. That's going to be the key. Is he going to want to see joblessness, or is he okay with the economy running hotter? Because the economy is running hotter right now. Some sectors are weak, like freight. But if he says that he needs the economy to weaken below GDP measures we have now, whether it's Fugazi or not, we're in for a crap show, and brace for impact. So again, if he needs joblessness to go up, if he needs the economy to slow below 2%, both of those are a problem. They haven't happened yet. And if he mentions the real rate, those three things mean we're screwed.